Most people say they don't have enough money to start investing. So I tested that excuse. Over the past 6 weeks, I invested £5 a day into the stock market. Not 500, not 5,000. £5. And what happened might actually change the way you think about investing. I'm going to show you firsthand how this investing stuff really works with a practical example you can follow along with. I'll walk you through the whole process, the starting point, deciding what fund to invest in, setting up my investing strategy, and dealing with some of the challenges that came along the way. And at the end of the video, we'll see what the results look like after investing for 6 weeks. I'm also going to break down some of the existing barriers that I know are still holding people back from starting their investment journey. Let's go. 5th of January 2026, the starting point. This is the point where most people actually get stuck. Perhaps you want to invest, but you don't really know where to start. And most importantly, you don't know what to invest in. So let me show you what this looks like in reality and just how simple it can be. You start by creating an investment strategy. So let's list this out so it's nice and clear. We're investing for long-term growth, so that's anything 10 years plus. And in order to achieve this, we're going to use equities as our main driver for that growth. What that essentially means is that we're going to be betting on companies to keep growing. And if we own a part of said companies, our money grows too. Simple. Now, there are a ton of other investing strategies you can use: bonds, commodities, property, or individual stocks. But for the purposes of this experiment, we want to keep things nice and simple. Okay, so we know we want to use equities to drive our growth, but how do you actually do that? Well, we're going to use something called a global index fund, which does two things. The first is that it gives us exposure to companies all over the world. Think Nike, Apple, Sony, even Greggs. Man, I could do with a Greggs right now. Having this exposure diversifies our investment. That way, if one particular company isn't performing that well, it doesn't hurt us as much because we have our funds spread across multiple companies. The second, and I think most important thing for many people, is that it just keeps the whole process nice and simple. We make one single deposit into one investment and it automatically distributes our money into thousands of companies all over the world. Nice and easy. Okay, let me show you how to set this up using Trading 212, and I'll also point out some important considerations when choosing your investment. We know we want a global index fund, and we're actually going to use the pie feature to help separate and track our investment. If we go to the app and click the pie icon, we can build our own custom pie. Add instruments, and we know we need to find a global ETF. Scroll to the bottom of the screen and select ETFs. We know in our strategy, we're going to be using equities as our driver for growth. But if you wanted a detailed breakdown as to what all these categories on screen mean, I have a full breakdown on my channel and you can find it on the attached card. Click on equities and then benchmarks and you'll see a number of ETFs. A very common fund is the Vanguard FTSE All World, which does indeed track the global market. If we click into it and scroll down, you'll see that it has an expense ratio of 0.19%, which is an annual fee for holding the fund. However, over the long run, these fees can really add up. I'm actually not going to use this Vanguard fund, and instead, if we go back and scroll down slightly, I'm going to use the Invesco FTSE All World. The main reason I'm going with Invesco is because it's slightly cheaper. Sometimes this won't be shown here on the information page, but to check, just click on the 3 dots at the top of the screen and instrument details. Here you can view the key information document, and if we scroll down slightly, you'll see the ongoing charge for this fund is 0.15%. Remember, this is just personal choice, but fees are the one thing that we can control, and especially when investing for the long term, it's definitely something you want to consider. Now that I've set up the pie, all I have to do is invest £5 a day, and I can make this even easier by automating the payment. But before we jump ahead 6 weeks and see how it performed, remember, markets don't move in straight lines. A lot's already happened this year, so let's break it down week by week and see how global events affected this £5 experiment. And while you're there, do me a solid and subscribe to the channel. I appreciate you. Week 1, cautious optimism. Early January saw markets reopen after the holiday period, and honestly, things were quite steady. The AI bubble conversation was still casting a shadow, but there were more immediate things on the horizon that would impact the markets. mainly the ongoing geopolitical tensions and inflation expectations and how the banks would react. As for my portfolio, like I said, things were quite steady. If we have a quick look at this chart showing our Invesco fund, we can see that there was a steady climb for the first and second weeks of January. And you can see that reflected here in my Trading 212 account with a slight gain of 1.3% and 1.7% respectively. When you invest small amounts daily, early fluctuations barely register, which helps create a habit and build momentum. Week 3, tariffs return. Mid-January is where things got interesting. This was the week fresh tariff announcements hit the headlines. New trade tensions, talk of import tax, and concerns about global supply chains. Here's why that matters, and I'm going to keep things really simple. Tariffs increase the costs of goods between countries. Higher costs squeezes companies for profits, and when investors think profits might fall, the markets react. And we can see that reflected here. When tariffs were announced, we saw expected volatility. Things dipped over the next week, but then we saw a slight recovery as tariffs were called off, which gave renewed optimism. In terms of my investment, we can see our first red week being down 0.8%. Week 4, the central bank. By late January, commentary around potential rate cuts started circulating. And over in the US, the Federal Reserve held interest rates steady, despite political pressure to reduce them. This is relevant to us because these things tend to be linked like dominoes. And I'm not talking about the pizza. That's twice I've mentioned food now. Man, I'm hungry. Higher inflation potentially leads to higher interest rates, which puts pressure on equities as economy growth can slow down. This uncertainty can be seen on the chart with fluctuations closing out January. For the second week running, my investment is in the red, this time down 1.3%. Week 5, tech leads the way. Early February saw big global tech companies report earnings, and strong data galvanized investors. And because global index funds are heavily weighted towards the US and tech, this naturally boosted my ETF. This can be seen here as the graph gradually trends up following a turbulent end to January. This is also reflected in my investment, as we're back in the green, albeit by a mighty 0.1%. Week 6, the pullback and reality check. We saw a slight pullback headed into the final week, which actually serves as a nice reminder that markets don't move in straight lines. They fluctuate, but the long-term trend over a number of years tends to be positive. This can be seen on the chart here. And even with this pullback, because I invested every day, even during the bad ones, I still managed to finish week 6 in the green at 0.4%. This gives me a grand total of, drumroll please, 38p. Was the point of this experiment to make significant money in 6 weeks? No, of course it wasn't. It was about showing how simple it is to start, that you don't need a lot of money, and that consistency beats emotion. I often say it's like the gym. You're not going to build a ton of muscle in 6 weeks, but give it time, stay consistent, and you're going to see some significant changes over the years. Plus, given the amount that's happened in 2026 already, it's quite the result I'm in the green. It just goes to show that taking the emotion out of investing and committing to a daily, weekly, or monthly routine can certainly compound over time. I'll keep this experiment going and I'll provide updates on the channel because I believe it's a great learning and reference point. Just remember that none of this is financial advice. When investing, your capital's at risk, and if in doubt, please speak to a professional. Hopefully this has given some of you the confidence to start investing yourself. I'd love to hear in the comments below. But before you go out and conquer the stock market, check out this video that goes over some of the biggest mistakes to avoid when using Trading 212. And on that note, I'll catch you in the next one, guys.